China has unexpectedly stopped importing LNG from the U.S., worth $2.4 billion per year, causing a shock to the global energy market. Australia has been chosen as a replacement in China's strategy to restructure its global influence. In March 2025, China suddenly announced the suspension of all LNG imports from the United States. This move is seen as a direct retaliation after the U.S. imposed a 10% tariff on Chinese goods just a month earlier. As the world's largest LNG exporter in 2024, with over 91 million tons in production, the U.S. unexpectedly lost access to its second-largest market. Immediately following the announcement, China quickly diverted its LNG shipments to Europe, avoiding U.S. tariffs and expanding its influence in a market urgently seeking energy alternatives to Russian supplies. While the U.S. is kicked out of the game, Europe becomes the new destination for China's LNG shipments. Countries like Germany, the Netherlands, and Italy swiftly adjust their import policies to take advantage of the cheaper LNG from Asia. The EU government quickly launches storage projects, expands seaport infrastructure, and increases investment in energy transfer systems within the bloc. With urgent energy needs in the wake of the Russia-Ukraine crisis, Europe welcomes the redirected LNG flow, while the US can only watch as revenue flows into the hands of others. The result, the US loses market share, loses partners, and loses its bargaining power in Europe, a market that had been central to its post-COVID and post-energy crisis strategy. While the US market is reeling, Australia quietly signs a $1.5 billion contract with China Resources Gas, one of China's largest energy conglomerates. This 15-year deal, starting in 2027, will supply 600,000 tons of LNG per year. Australia's LNG is not only 20% cheaper than American gas, but also takes 10 fewer days to transport due to its closer geographic location to China. The Woodside contract is not just a commercial success, it's a geopolitical statement. Australia, a longtime ally of the US, is now China's leading energy partner. China, with a population of 1.44 billion and being the second largest economy in the world, has massive energy demands, making LNG the backbone of its national energy strategy. After the US imposed tariffs on Chinese goods in 2019, Beijing began gradually reducing its dependence on US LNG. By 2024, LNG from the US accounted for only 5.4% of its imports, down sharply from nearly 20% previously. Instead, China has proactively signed long-term agreements with Qatar, Russia, and Central Asia, invested in the East Asia gas pipeline from Russia, set to operate in 2027, and strengthened strategic cooperation with Australia in both LNG and critical minerals. All of this is to maintain energy autonomy and avoid reliance on a single partner, particularly amid ongoing trade tensions. Before China stopped imports, the US exported about 400,000 tons of LNG to China annually, generating $2.4 billion. However, after the suspension, US LNG export terminals are left with piles of unsold stock. Contracts are canceled, and shipping costs skyrocket. Meanwhile, Australia, which had previously trailed the US in LNG market share, seizes the opportunity, surpassing the US to become the primary LNG choice for China and many other Asian economies. With this shock to the billion-dollar market, the US LNG industry faces the risk of restructuring. While the global energy market has entered a new era, price but also geopolitical strategy will be the deciding factor. In February 2025, the Trump administration slaps a 20% tariff on Chinese goods, escalating trade tensions. China retaliates hard, cutting US imports while strengthening trade ties with Canada and the European Union. The result? American farmers and businesses lose a multi-billion-dollar market, while Canada and Europe cash in. Was this a strategic miscalculation by the US, or part of a bigger game plan? Canadian oil replaces US supply. For decades, the US was China's top supplier of crude oil and natural gas. But in March 2025, after Washington hit Canadian oil imports with a 10% tariff, Ottawa found a new buyer, Beijing. China immediately ramped up oil imports from Canada, primarily through the Trans Mountain Expansion, TMX pipeline. This infrastructure upgrade boosted capacity from 300,000 barrels per day to 890,000 barrels per day, opening a direct, cost-effective route to Asia. Now, 50% of Canada's crude oil exports flow to China, shifting Beijing's long-term energy reliance away from the U.S. Canada isn't just stepping in with oil. Liquefied natural gas, LNG, is another sector where Canada is filling the void. The LNG Canada project, one of North America's largest LNG export facilities, is set to start operations in 2025 with an export capacity of 14 to 26 million tons per year. Previously, the U.S. was one of China's largest LNG suppliers, but after Washington imposed trade restrictions, China shifted to Canada, Qatar, and Australia to diversify its energy sources. The result? Canada is now cementing its role as China's strategic energy partner, gradually replacing the U.S. China also cuts U.S. agriculture imports. As one of the world's largest agricultural buyers, China has dramatically scaled back U.S. imports since 2023. The most impacted sectors are soybeans. In 2016, the U.S. supplied 40% of China's soybean imports. By 2024, that dropped to just 18%. Meanwhile, Brazil and Argentina now account for 74%. Wheat, corn, and cotton, once key U.S. exports to China, are now being replaced by South American and European suppliers. Spain and the Netherlands have become the new pork kings for China, which has significantly increased meat imports from Europe. Why? Stronger food safety regulations, more stable supply chains, and competitive pricing versus U.S. exports. In 2023 alone, EU pork exports to China surged by 35%, while U.S. pork exports plummeted due to tariffs and stricter Chinese inspection policies. For American farmers, this shift is a nightmare. Losing China's massive demand means overproduction, falling prices, and declining profits. Smaller farms are at the highest risk, as they lack the resources to pivot quickly. It's not just agriculture. America's industrial sector is feeling the heat too. China is cutting investments in the U.S. Tech giants like Google, Tesla, and Intel are losing Chinese market share. China is shifting its partnerships to Canada, Europe, and BRICS nations. The long-term impact? A gradual decline in U.S. global influence. This trade war is reshaping global commerce. Canada and the EU are winning, capturing billions in lost U.S. trade. The U.S. is losing ground. American farmers, tech companies, and industries are feeling the squeeze. The big question is, will the U.S. shift strategies to regain lost ground, or is this the beginning of a long-term decline in U.S. economic dominance? If Washington doubles down on tariffs, it risks further isolating American businesses from global supply chains. Meanwhile, Beijing's aggressive trade diversification is creating new alliances that could permanently reshape global economic power. The longer this standoff lasts, the harder it will be for the U.S. to reclaim its lost influence. While billions of dollars are being poured into the F-47 fighter jets, the economy and politics are in turmoil. What is going on? Trump announces the F-47 jet. In a recent press conference, the president unveiled the development of the F-47 jet, a replacement for the F-35. The F-47 will be the most advanced, most capable, most lethal aircraft ever built, he said. This is part of a broader strategy to enhance military power, with hopes of making the U.S. the leader in military technology. However, the cost of this project has raised concerns among the public. The U.S. currently spends a staggering $800 billion per year on defense, while millions of citizens are suffering from budget cuts to social welfare programs. This has led many to question whether military projects are truly worth the cost when citizens' lives are not being prioritized. With wars and international tensions still ongoing, can the U.S. maintain a strong economy while pushing forward with defense projects like the F-47? U.S.-Canada relations are also heating up. The president recently stirred controversy by calling the U.S.-Canada border an artificial divide, and even expressing a desire for Canada to become a state of the U.S. But is this strategy truly realistic in the current context? Canada is a major trade partner of the U.S., with bilateral trade reaching over $600 billion annually. Moreover, Canada plays a key role in international agreements and maintains an independent foreign policy. Could this conquest push lead to a positive relationship between the two nations, or will it spark major tensions in the region? Canada's response has been clear. increased defense cooperation with European countries and Australia. Additionally, Canada is focusing on strengthening alliances with other allies like Japan and South Korea to safeguard its strategic interests in the region. This could complicate relations with the U.S. if these strategies aren't closely aligned. In the age of globalization and international security threats, shifts in the relationship between these two countries could have far-reaching impacts on North America and the world. In a surprising move, President Trump expressed his admiration for King Charles and the idea of a monarchy, even suggesting that the U.S. joining the Commonwealth and accepting King Charles as a leader would be a great choice. But is this a joke? Or is it a signal of a deeper reconsideration of the U.S. leadership structure? The Commonwealth currently consists of 56 countries, and joining could shift the international relations landscape of the U.S. But this would mean giving up some sovereignty. Furthermore, joining the Commonwealth would require the U.S. to accept the leadership of a king, which could contradict the democratic principles that the nation has always upheld. While this idea is controversial, it reflects a shift in how the role of the U.S. on the international stage might be perceived. If the U.S. were to seriously consider joining the Commonwealth, it could lead to significant changes in diplomatic relations and impact traditional alliances. Trump recently discussed mass deportations without adhering to legal procedures. This could have serious consequences for the U.S. legal system, where the rights of citizens and immigrants are typically protected. A hardline policy could create tensions among social classes and increase opposition from citizens' rights groups. Moreover, without comprehensive solutions in areas like education, employment, and integration, these measures may only serve as temporary fixes and fail to address the root causes of immigration issues in the U.S. Could these decisions by President Trump bring about a positive change for the U.S. economy and international relations? Or are they just controversial steps? The real issues facing the American people, like economic struggles, healthcare, and education, often get drowned out by these headline-grabbing moves. The U.S. economy is facing serious challenges. OPEC has just made a bold move, cutting oil production and driving prices up, putting the U.S. in a difficult position. The U.S. is fighting back by boosting shale oil production, reaching a record high of 13.49 million barrels per day in December 2024. But shale oil is expensive to extract, and with financial institutions shifting toward clean energy, the industry faces pressure. The rise of electric vehicles is also reducing gasoline demand, adding more challenges for oil producers. High oil prices fuel inflation, and the Federal Reserve may have to raise interest rates, risking a recession. The U.S. needs Canadian oil more than ever, but trade tensions are complicating things. In March 2025, the U.S. will impose a 25% tariff on Canadian imports, and Canada is hitting back with counter tariffs. Canada's oil and gas are critical for the U.S., and any restrictions could send fuel prices soaring. The big question is, can the U.S. secure its energy needs and maintain its economic dominance, or is this the start of a long decline?